During the early formation of the United States, private and state-operated banks proliferated using proprietary currency and were regulated by their own internal fiscal policies. This proliferation increased the money supply but led to inconsistent commercial and personal banking regulations, a lack of customer protections, and a general lack of confidence in the circulating currencies. The battle for independence that was declared in 1776 by the founders of the developing United States of America began in 1764 when the Currency Act of 1751 was extended by King George III. That legislation required the United States to operate on notes from the Bank of England, governed all of the British colonies of North America, and forbade the U.S. from designating future currency emissions as legal tender for public and private debts. The first Bank of the United States was chartered in 1791 and was supported by Alexander Hamilton, who lobbied for taking on the debt of the Revolutionary War and the individual states. Thomas Jefferson opposed what amounted to a central bank because he believed that it gave too much power to too few people, as it was a privately held bank with the United States owning a minority share and private and foreign investors holding the remaining majority share. As the United States grew, its citizens increasingly grew to resent the power and control that the bank exerted over the country, the state, and private banks. The charter for the first Bank of the United States expired and was not renewed in 1811 because of a lack of political support. The United States was immediately attacked by Britain in the War of 1812. The Second Bank of the United States, a central bank, was promptly created by Congress in 1816, but would not be renewed upon its expiration in 1836 due to fierce opposition by Andrew Jackson, the then President of the United States. It was not until 1864 that the National Banking Act established a system of national banks and created the United States National Banking System. The Office of the Comptroller of the Currency issued national currency and taxed state banks, making them unprofitable to pave the way for the Federal Reserve. By 1910, a meeting was convened on Jekyll Island in Georgia, attended by the wealthiest business leaders in the United States. The Central Banking Act was drawn up as a result of this meeting, and the Federal Reserve Act was passed in 1913, creating the Federal Reserve Bank. During World War I, which ended in 1918, there was heavy government borrowing to pay for the war, and the gold standard was abandoned to clear the way for an expansion of the money supply and devaluation of the US dollar. This monetary expansion caused the economic boom that fueled the Roaring Twenties. That boom led to an overproduction of goods stimulated by the Industrial Revolution. The easing of credit and lowering of interest rates led to an overextension of credit, and the use of credit to primarily invest in the stock market increased capital investment in the stock market. These factors combined led to the stock market crash of 1929. Once product sales slowed down, stock valuations began to fall. Since much of the investments were made with borrowed money, investors were being called upon by the investment companies and banks to pay back that money. This would force investors to withdraw money from banks, causing banks to have less money on deposit, leading to a lack of confidence in the banks, and an eventual run on the banks to withdraw any remaining funds. Banks failed. Business finance ceased, the economy collapsed, jobs disappeared. This was the cause of the Great Depression. The crash would precipitate the construction of a global banking system, beginning with the Bank for International Settlements established in Basel, Switzerland in 1930 to serve as a bank for central banks. Banking regulations were put in place to rebuild confidence and stability in the system. In 1933, the Public Banking Act, also referred to as the Glass-Steagall Act, separated commercial banking from investment banking to prevent banks from mixing the business of risky investments and principal-protecting products. The 1934 Securities Exchange Act was passed to protect interstate commerce, the national credit, and to ensure the maintenance of fair and honest securities trading markets to be overseen by the Securities Exchange Commission. The Banking Act of 1935 was created to restructure the Federal Reserve, affording it more control. In 1944, the Bretton Woods Conference would bring about some of the most comprehensive global fiscal policies and financial institutions, including the General Agreement on Trade and Tariffs, the International Monetary Fund, the World Bank, and the Dumbarton Oaks conversations which led to the creation of the United Nations. Most importantly, though, the US dollar was made the global reserve currency linked to gold, and all other world currencies linked to the US dollar, forcing global commodities to be priced in dollars. This created a built-in demand for the US dollar. Finally, in 1951, the Federal Reserve Accords certified an agreement between the U.S. Treasury and the Federal Reserve to restore independence and autonomy back to the Federal Reserve so that the U.S. government would have no say in its operation. Where the post-Depression era saw increased regulatory activity in an effort to reform and bring confidence to the banking industry, the 1980s and 1990s would serve as the era of deregulation, undoing many of the policies and safeguards that were put in place by loosening what were seen as constraints on the industry. In 1980, the Depository Institutions Deregulation and Monetary Control Act and Garn-Saint-Germain Act in 1982 relaxed interest rate controls and allowed banks more flexibility. This deregulation created the environment which brought about the savings and loan crisis, which led to the failure of over 1,000 thrift banks that were originally designed to provide home loans with government backing. Many savings and loans began investing in speculative real estate and other high-risk ventures, often with poor oversight and in some cases fraud. It was one of the largest and most expensive financial scandals in U.S. history. The key drivers of destabilizing deregulations in the 1990s were the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994, which allowed banks to operate across state lines more freely; the Commodities Futures Regulatory Act of 1996 exempted certain derivatives from regulation, leading to a proliferation of collateralized debt obligations. The gradual dismantling of Glass-Steagall provisions culminated in the Gramm-Leach-Bliley Act of 1999, which officially repealed the separation between commercial and investment banking, fostering speculation and allowing affiliation between banks and insurance underwriters. The 1990s specifically can also be seen as the era of megabanks, as regional banks merged to form national and even international financial institutions. Mergers were now strategic tools for expanding customer bases, diversifying services, and achieving economies of scale. By the end of the 1990s, the U.S. banking landscape had dramatically changed, with fewer but much larger institutions, setting the stage for systemic risk challenges highlighted during the 2008 financial crisis. The new millennium bore witness to a convergence of events. The consequences of deregulation and unprecedented stock market conditions of the 80s and 90s culminated in the 2008 financial crisis. The bursting of the internet bubble in 2000 would mark an end to what was at that time the greatest creation of wealth in human history. The downturn in the market would cause the investors who benefited from that wealth creation to move their money out of the stock market, specifically internet stocks, and into real estate. In 2000, the Commodity Futures Modernization Act empowered the creation of and investment in exotic derivatives. In 2003, Barney Frank principally advocated in Congress for using the government's authority to force lower underwriting standards in regard to home financing for underserved communities. In an effort to compete with the government, commercial banks began lowering their standards of underwriting. This loosening of standards, combined with a proliferation of the creation of exotic new investments and fewer but larger banking institutions, created an intersection of events that gave the 2008 mortgage and financial crisis its global breadth, impactful depth, and lasting duration. The crisis triggered the unprecedented mergers of some of the largest commercial and international investment banks. J.P. Morgan Chase acquired Bear Stearns, Bank of America acquired Merrill Lynch, Wells Fargo acquired Wachovia. The Emergency Economic Stabilization Act provided $700 billion of taxpayer money to buy such troubled assets as AIG, Bank of America, Citibank, JP Morgan, and General Motors. The too big to fail phenomenon intensified, sparking public debate and regulatory reform. The 2008 to 2009 financial crisis is a key inflection point for bank-like institutions or non-depository intermediaries to gain prominence. Dislocations in credit markets created opportunities for non-bank lenders, which Blackstone began exploiting more aggressively. BlackRock's banking activity is mostly indirect, as an investor in banks via public equities, index funds, and exchange-traded funds, rather than as a lender or as a bank itself. Thus, its regulatory risk is about influence and control, conflicts of interest, disclosure, and voting or stewardship. Blackstone is more directly involved in non-bank credit origination, insurance investing, and real asset ownership. These are more bank-like in the sense of credit risk, funding, infrastructure, but they are still generally not depository institutions. Both are part of what might be called the shadow banking or non-bank financial intermediation ecosystem. As bank regulatory burdens increase, more lending, especially risky or illiquid lending, is shifting to non-bank players like private credit firms. Blackstone is a big part of that shift, and BlackRock is increasing exposure via private markets.